I'd like to ask our panel number 4 to come forward. Jeff Jones is going to be our moderator for this panel on financing technology. So now we've talked about what are the new technologies, where are we going, what's the future, now how do we pay for it? Jeff Jones is Vice President with Growthink. Mr. Jones has an extensive background in corporate finance and financial services with an emphasis on assisting emerging and middle market companies with depth and growth financing. During his 9-year tenure at Growthink, he has led more than over 300 client engagements spanning industries including IT, healthcare, financial services, mobile, real estate, consumer products, and media entertainment.
All right. Well, thank you, everyone. Thank you for that nice introduction. As was introduced, we are the finance guys. My name is Jeff Jones. I'm the COO and Vice President of Growthink. We are a 15-year-old consulting and investment banking firm here in Los Angeles, and we focus on strategic consulting and a lot of fundraising assignments, transactions, and M&A work. And I have a lot of experience in the manufacturing space, and that's why I'm here today specifically. So the purpose of today's event is really to promote California's manufacturing community and to educate and assist companies like yours with different growth scenarios that involve technology. And let's face it, we've heard a lot of panelists today talk about how competitive the space is here. And companies from other states, from other countries, stealing market share from California manufacturers. And that has been going on for 20-plus years. The good news is that California, especially Southern California, is still the biggest manufacturing center in the country. But in order to grow, you must create competitive advantages. And technology must lead the way. I don't care what industry you're in. And I see this a lot in our banking practice, dealing with 200 industries at any one time. So how do you do that? Well, raising money is as much of an art as it is a science. And so you need to understand your industry landscape, what's going on around you, being aware of and implementing new innovations, leveraging technology, creating efficiencies within your operating models. It's very critical for manufacturing companies, all very important factors for growth. And so, as we all know, business growth, especially involving investments in technology, always requires capital. And so, as you build your business, acquiring assets, resources, technology, improving your skill sets with your workers, education, training that was mentioned, adapting your product to your product lines, gaining customer relationships, you fund that build-out with either cash flow from ops, and of course, if you have a luxury on your balance sheet to do that, awesome. If you don't, you have to look outside the company financials and secure some kind of financing partner to help. And so we come in many forms up here in the panel. I think Kelly from Fremont on the last panel, hi Kelly, she alluded to this. We have a huge advantage as California business owners here especially. And whether it's traditional lending platforms that you heard about today, alternative financing to private equity, in terms of what I do. We have access to more capital in this state than anywhere in the country and arguably anywhere in the world. And it's about how to access it that we're going to talk a little bit about that today. So the objective of the panel is to discuss the aspects of financing, this technological growth initiative, and as a manufacturer, trying to access the right kind of capital for your company. So we have a diverse group of gentlemen up here today that represent and are experts in different forms of financing. Their feedback hopefully is very informative, and we should get a lot of good key takeaways from the dialogue. So let's begin with the current financing trends within the manufacturing category in California. Describe the activity that you're seeing.
One thing that we do at Grow America Fund is that we focus on the dynamics of growth of a small business. It's sort of logical when a business needs equipment or they want to increase their technology base and they want to go out and add a new production line to buy equipment or maybe to buy a building or lease a building to house that equipment. But what we tend to focus on, along with that, is that a manufacturer especially has different dynamics associated with funding that growth. New equipment, new space translates into new sales. That translates into new needs for inventory, new needs for accounts receivable. So something that we've noticed is that, in general, the financing community tends to respond more quickly to fixed assets or hard assets. It's easier to get your arms around real estate, leasehold improvements, buying a new machine or several machines. But the component that goes along with that permanent working capital need, is something that we've noticed is typically lacking, or it's, we'll get to you later. We'll worry about it when you have a problem. And what we try to do is always focus on that up front, try to anticipate what those needs are. Sometimes we don't get it right. Very often we do, where we can actually go in and say to the business, okay, here's your financing package, here's your machinery and equipment financing, here's your real estate financing, and oh, by the way, here's your permanent working capital growth financing along with that. And that's something that we've noticed is always an issue with small business owners because they're focused on the hard assets, but not necessarily the permanent working capital.
We're building in Santa Barbara an entrepreneur eco-environment. And what that means is not only do we provide the money, but we provide the resources and the management skills. And our resources are worldwide. We handle high-tech, low-tech, no-tech, biotech, medical device, and we're connected with the government through NIH, NSF, and DARPA. And we pick up their programs after they've already exhausted their monies, and now we move them on to you guys. So that, you know, someone said manufacturing's undersold. It's not even mentioned because we consider it an absolute integral part of every job, every deal. And if it isn't part of the deal, how in the world is the product going to get on the market? So you guys are family to us, and it's very, very important that you exist. And we always like to work and mentor not only the companies, but you guys. Whether you outsource or insource or whatever process you want to use, we want you there. And it's quite an extensive. We've been around for 18 years, and each year we put on what we call the Clean Business Investment Summit. We argue with what clean tech is because no one can really define it. We chose clean business because if we went green, the government will change it to purple, and then I got to change all those signs. So we go ahead and stay with clean, and what we mean by clean is very simply ethical, sustainable companies. And we work to make sure that is assured. So we're here to help you. We're not like the government.
Hi, I'm Brian Harrison from American West Bank. Just a little background. American West Bank, it's a business-focused community bank with branches in 5 states, including right here in LA, Inland Empire, and with myself from San Diego. So we're in the 5 western states, about a $4 billion bank, as mentioned. So we're a community bank. We target one of our target audiences, obviously, is manufacturing companies and technology companies, and we strive to get to understand the business, get to understand the management team, the years that they've been in business, and we're really the advocate as a relationship manager to support that credit need. We're seeing across the bank-wide an increase in the interest for equipment financing in the 5 western states that we're a part of, which is driven by an increase in the confidence level to expand inventory levels, and at least partially due to product demand.
What are the different types of capital that can be accessed within this space, both traditional and alternative?
Traditional financing comprises equipment loans, permanent working capital loans, asset-based lines of credit, including revolving lines of credit. If clients are looking for a term loan, standard terms are 5 to 7 years, so we could handle most of those needs with our traditional financing. If they're looking for a longer period, in this case to fund either real estate or equipment, we could go up to 10 years with an SBA loan, and for a building acquisition, we could look to an SBA 504 financing or just a conventional loan.
It's kind of crazy when you look at the world we live in. We're talking about equity financing, angels, VCs. We put on a program every year, and this will be on the 11th of September this year at UC Santa Barbara. And we do it in the nice pavilion we have on campus there, Corwin Pavilion. In that day, we present 17 companies to 22 investor groups, and this year we'll probably have 35 investor groups. Because the big program after they present, and we talk many, many weeks prior in mentoring them. And what we do when we talk about financing to them is there's no limit to where you go. These guys are partners. We can't do without the banks. We have a number of banks there who are, we call them investment banks, but these guys are too. Because you're going to need equipment and you're going to need financing for equipment. Now what we've added is a new thing. The investors pay for that equipment loan, and the customer, the entrepreneur, pays the investor. Kind of a clever trick. So the bank has to be there, lines of credit and everything else. Also, there's a big move the last few years on convertible debt, big time in the world of angels and VCs, which is really a surprise. And the old rules about a VC, if you don't want 6 or 7 million, or if you want 6 or 7 million, you have to go to a VC. And if anything lower than that, forget a VC. I got news for you. That rule doesn't apply anymore. I was kind of shocked one day. I went to lunch with a VC, a big one in Santa Barbara, and he sat there with a big Cheshire grin on saying, if I say what I'm going to say, will you laugh? And I said, I don't know, I haven't heard it yet. So he said, I just invested. And I said, how much? He said, $50,000. And I almost fell out of my chair. This is a major VC. And I said, why'd you do that? He said, it was exciting. And it looked like it had good promise. That's good enough for me. That's the attitude of the investors. After we present those 17, we send them off we have cocktail tables set up out in the patio, no chairs. Each table is manned by an investor of some kind. The investors know who the entrepreneurs that presented and are attending. Those folks know the investors, and we just let them go at it for 3.5 hours. And you tell me and it's not speed dating. It's your time, okay? So the description of the deal is between you and the investor. There is no limit. Isn't that wonderful?
For a small business, a manufacturing business, the business owner needs to focus on getting the right kind of capital into the operation that suits their needs. And what might work for the company on this side of the street might not work for the company across the street. And a mixture of this type of financing is really what we see. From an analytical perspective, when we're looking at hundreds and hundreds of businesses each year, we're seeing the results of that. What is this loan? That's a loan I got from my grandmother. She had some money. She loaned it to the business. It's patient capital. Hey, that's a good source of funds. It's patient capital. Why not, if you can get it? If you don't have a rich grandmother, you might have to talk to people like us, and that's okay. Our typical product is a term loan. We go out to 10 years on machinery and equipment. We finance 100% of it. The idea behind that is pretty straightforward. If the business, like I said before, if the business needs the equipment to make something, to do something, they have to buy the inventory or the raw materials to make something. If you have to put a lot of money down on that equipment, you don't have that cash anymore to go buy your raw materials. And then you might have to go and borrow on a credit card or borrow from the bank on a line of credit or something like that. So the idea is maximize that leverage as much as possible on the equipment. We go out 10 years. Why? Machinery, some of this machinery lasts forever. Some of it you might not want to last forever because technology is changing and improving. But from a durability perspective, 10 years is a pretty good term. I've seen manufacturers that are able to put to use ancient machines that are 30, 40, 50 years old. It might not be doing exactly what they did 30, 40, or 50 years ago, but they're productive. So we'll go out as long as we possibly can. Real estate will go out to 25 years on a commercial real estate mortgage, or a deed of trust, I should say, here in California, as well as 20 years depending on the product. We start off with 90% financing, and very often we go higher than that. Even if the appraisal doesn't come in, we'll take everything you own and your children and their children and things like that. Don't worry about it. But the idea behind it is, again, coming back to the down payment before, if you're putting 10, 20%, 30% down on $1 million building to house your manufacturing operation, that money is gone now, buried in the bricks and mortar. It's no longer available to finance accounts receivable and inventory. But a mixture of this kind of stuff is really helpful, and depending on what's out there. The general rule of thumb is matching the source and use of funds. If you're going to use the asset for 10 years, finance it for 10 years. If you can use the asset for 20 years, finance it for 20 years. If you're only going to use the asset for 2 years, don't finance it for 10 years. Try to match your source and use of funds, and it usually will work out. But even then, you should always work your relationships with your lenders, your bankers, your municipalities. One thing that we do is we run loan programs for municipalities all over the state of California, really all over the country. We leverage those local dollars where we turn $1 from a local community into $4 by using the SBA Guaranteed Program. Effectively, what we're doing is we're bringing the SBA Guaranteed Program into your local municipality. work those relationships too, because when you need funding, you have to look at many different sources, and it's really a mixture for what you need.
So it's a very good point, John, and to piggyback too on what Jerry said, it depends on the company, and there are a lot of access points for capital that I think a lot of people maybe in this room, especially in manufacturing, don't realize. On the equity side, things are a little bit different. Obviously, you're always going to need your conventional banking sources, absolutely, in your business, especially since it's so asset intensive. But the institutional community, private equity funds, venture capitalists, angel investors, family offices, do invest in this category. Yes, there are a lot of people in Silicon Valley and Silicon Beach down the street that want to see that big tech growth trajectory, that hockey stick growth trajectory that gets them $2 billion valuations in 2 years. Okay, but there's also those investors out there that like those blue chip plays. They like steady growth. They like build up, that a business is going to last for 10, 20, 30 years and beyond. So those markets are open and they are accessible. You just have to know how to access them. And so that's a very good point all the way through, guys. Thank you. All right, next question. We'll go back to, start with John again. What are the requirements for funding, and how should a company prepare to approach potential lenders and investors?
The usual suspects is what I call them. 3 years financial statements, 3 years tax returns, personal financial statement of the owner, credit history. What you're buying or what you need the money for is kind of a fundamental thing. Being able to articulate what you need to the lender or to the angel investor or to the equity investor. I need X dollars and this is what I'm going to do with it. This is how I'm going to deploy those funds. This is where I'm going to spend it. This is what I want to do with it. Not, I could really use $1 million, but I'm not sure, but I'd like to have it just in case. That's not going to fly. Because whoever you're talking to, that lender or that investor wants to know exactly what's happening with it because they need to know how it's going to be repaid. If you're not deploying it, or if you're kind of gray about how you're going to deploy it, it's not going to work. Now, one thing that I always like to get out in the open when I'm meeting with a new business is if they have any skeletons in the closet. Over the course of a manufacturing business or any kind of business, something could have gone wrong at some point. Maybe there was a tax lien 6 years ago. Whatever reason that was caused, if the tax lien was paid off and the business has moved on, you can turn that into a strength. I had a problem. There was an illness in my family. I couldn't focus on the business for a brief period of time. It resulted in a tax lien, but guess what? I paid it off. You turn that negative, which is a tax lien, into a positive, which is strong character, and that you paid the obligation off. So don't hide it. Don't try to hide it. Don't try to run away from it. If there's something that's out there, be upfront with it and let the lender or the investor know so that they can do what they need to do with it and deal with it and help make their decision.
We apply all those principles whenever we talk about due diligence. But prior to that, when we sit down and talk to you, usually one-on-one, the first thing I want to determine is, are you ethical? Are you going to be honest? Are we going to play sub rosa games? If that's the case, the deal's dead right there. What we have is, we expect you to have a bag. That's spelled with an H, B-H-A-G. A big, hairy, audacious goal. And we want to see the emotion about that goal when we talk to you. If we don't see emotion, you're there, well, I need to get some investment money. That deal's dead too. Because if you don't have emotion and emotionally tied to your effort, who's going to have it? And you're going to be spending our money, and I like our money to have excitement with it. So we've dropped the term business plan and we go to growth plan, and that's thanks to some friends of ours that are in the 10,000 Businesses program with Goldman Sachs. One's sitting right over there, she's laughing. But that's very important to us because we want to see that you do have growth. We don't like hockey sticks, and we'll adapt that. We want that growth plan, but not quite like a hockey stick because that's a little optimistic. But you know, we want to see that you're going to do it. And then we want to see that you know how much you need. If you come and say, well, I think I need between $1 million and $2 million, that meeting's over. If you haven't thought it out, call us and we'll show you how you determine it, because it's a real easy trick. So you come and say, this is the money I need, and this is how I'm going to use it. You heard that from John. So we want to see that too. because we want a validation that, first of all, you have really looked at what it is it's going to take to do the business. If you see, the added advantage is, if you don't know, you call us, and we'll help you search it out. So that's what we really expect to see.
You know, one of the things that we really rely on are the strength of the financial reporting and the management team that are in the corporation or in the company that's coming to us for a credit request. So whether they're level of quality, being audited, being the highest level, or reviewed statements, those are pretty important for us to have those. If they're not reviewed, then they'll be compiled either by CPA or internally prepared. Reviewed would be in accordance with GAAP, so there's going to be most likely a higher net income number than if you have a tax return, which is really done to reduce taxes. So if we have reviewed, we can rely on those and use those for our purposes of analyzing, spreading the company. Another important factor in the credit decision, as I mentioned, is a strong management team that have been with the company for a number of years. You've got to have a good story. When you do go to a financial institution like a bank, and you are asking for funds, really be specific as to the use of those proceeds, what they're for. Sometimes we get into a situation where we're being asked, or we'll ask the question, what are you looking for? And they say, well, $500,000, $1 million. And we ask, what's that for? And it's not really a definitive answer. So really be prepared with your reporting. The information that gets to us, the sooner it gets to us, the sooner we can start working on the transaction. Some of these transactions can take 3 weeks to a month if they're delayed because we're not getting the financial reporting information that we need. So the quicker we get that, the sooner we can start on that. Really, a traditional bank, and whether you're talking about the largest banks in the country or community banks, really look at cash flow for our repayments for us, and that's why the reliance on those financials is so important. Secondly, we're not a collateralized lender, so we really look at cash flow. We're not really looking to sell the collateral to get a repayment source for the loan. So I think it's really just a matter of getting the real good story. If there are any issues, go skeletons in the closets, really address those up front. Some of those can be mitigated as long as we know the explanation. We're really looking at trends. That's why we ask for 3 years tax returns, trends on the revenues, trends on the earnings. So all that information is really important in the story behind it, and what are the reason for the funds for your growth.
Something that we always look at and we always ask for, and we're always comforted when the business owner is able to say, of course, I've got it right here, is an aging report of receivables and an aging report of payables. If they're familiar with what's on that document, who their customers are, what the timing is behind it, that comes back to that strong management that was talked about earlier, that Brian mentioned. And it's something that we need to see anyway. It's part of our due diligence list, but I'm always comforted when they say, it's right here on my desk, I printed this up this morning and I've been making phone calls, or these are my customers, I need to work with them. And that just shows us a real nice connection that the business owner has to their customer base.
The first thing we're going to ask for is proof that you own the IP, intellectual property. And if you say, well, I don't have any intellectual property, we'll teach you what that is, because you do own the IP. And make sure that you have some indication. We also like market validation. Now, if you haven't produced a product, how are you going to do that? Very simply. You go out and you find out where the market is, and the minimum we expect you to have is an LOI. An LOI is a letter of intent that says that person you talk to is interested in what you're doing. It's no legal commitment, but at least you're getting some opinions from people that says, yeah, if you build it, I probably would like to see some. I'd like to maybe buy some. And that's called market validation on the early stage. If you have a prototype, then you have a little bit more action going out to your customer base.
So a quick follow-on to that question, I get a bit more granular into use of funds for each of you. What's normal and acceptable use of funds for raising capital through your firms?
As a small business lender, the key word being loan, we typically finance hard assets in addition to permanent working capital. So what does that mean? We'll finance machinery and equipment, we'll finance commercial real estate, we'll finance what we calculate as accounts receivable and inventory growth. And that gets a little vague, if you will, but we work with the business to try to figure that out by looking at the dynamics of growth, meaning if you have an LOI, you have a purchase contract, and revenue is going to go up by a certain percentage, and we understand that at a certain level of revenue, you have to have a certain dollar amount invested in accounts receivable, and a certain amount of inventory on hand to support that growth, we'll fund that too. So that's typically what we're looking at is permanent working capital, receivables, inventory, and of course hard assets.
First thing I look for is salaries of the executives. You can't believe what I see. And I said, first of all, you're not going to get any salary for at least 6 months. Can you do that? Well, I don't really hold to that, but I sure don't want to see big numbers in there for the salary of those people because that's a sinkhole. The second thing I don't want to see is, well, I have these debts I have to pay off first. Really? That's not going to make a deal either. So what we want is reasonable charges, and there's ways to do it. You can use common factors and see if the month-to-month expenditures are correct. So everything stays in the proper ratio. You don't have any big hiccups unless you have, say, certain things you have to pay to the state, and that hits in a particular month, or insurance and those things. But we examine a month-to-month, and we want to see a 3-year by month projection. And we want to just see how your thinking is as you go through that process. And reasonable numbers are reasonable numbers, but they have to be justified. And by using that particular document, we can tell you exactly how much money you're going to need, and we believe in tranching. And we tie the tranches to milestones. So milestone achievement gains you the next tranche. If you don't meet the milestone, you got some splaining to do, okay?
It's really important, I think, from the start to really go to the right type of lender for the type of use that you have. So an example of financing a target where you're going to buy a business, a bank can traditionally do that type of transaction based on the cash flow that's generated from both of those companies, the existing company and the target. But we really want to make sure that you engage your bank or your financial institution, mezzanine lender or equity player early on to outline the type of transaction that you're doing to make sure you match it with the right type of funds and the right type of lender. If it's a business acquisition, you really want to look at a business valuation by a certified business valuator. A bank's going to rely on that, and if it's done for an SBA loan, there's certain criteria that's required that's incorporated into that business valuation up front. So that has to be addressed early on, because we do get business valuations after the fact where they haven't told the banker. They bring the business valuation, and we really need that to go back to the business valuation person and get readdressed to the bank and incorporate certain factors. Our bank, like most traditional banks, will lend on accounts receivable up to typically 80%. For those eligible under 90 days, eligible receivables are under 90 days. If it is outside of 90 days, there's less reliance on those that they're going to be collected. We'll look at inventory. Inventory can be advanced anywhere up to 50%, depending on the type of inventory. If it's perishable inventory, much lesser advance rates. We'll do equipment financing, whether it's used or new. Every bank has a different criteria. Whether it's used, it may be 75%. If it's new, maybe 100%. And they may be in a 5 to 7 year term. If it's longer, we look to a SBA type of structure to go up to 10 years. Buildings, if you're going to buy a building, then we'll look at either an SBA 504 to do 90% financing, or we'll do a conventional loan to 75%. So I think it's just really, any takeaways is engage your financial source early on and make sure that you're matching it properly so that you don't spend a lot of time with the wrong direction for that regard.
For everybody on the panel, demonstrate maybe a successful case study where you've facilitated an actual financing for a client or a customer within the manufacturing space. Maybe walk through a little story for everyone so they know it does really exist.
So we were working with a company that made sheet metal cabs. So if you look at a crane on a construction site, the crane operator sits inside kind of a sheet metal box to protect them from the weather. Often at the airport, not here in Southern California, but if you go back east where it gets pretty cold, there are little tugs that drive around the luggage carts, and they have like a sheet metal box around that area. And the company that we worked with was a manufacturer of these specific types of sheet metal boxes. And it was a 100-year-old company, and they'd been working with their bank for years. But something happened at the bank where the bank was basically backing away from small business lending. And they called their particular line of credit. Now, the company had been doing well. They'd been around for 100 years. They were on the third or fourth generation as far as management was concerned. They were profitable. They had cash flow. but they had a line of credit financing $1 million worth of working capital, and the agreement said, it's due. So the bank called up and said, it's due. So what we did is we sat down with the business and we said, you know what? A big chunk of what you have under your line of credit is really what we refer to as permanent working capital. The permanent dollars that are invested in receivables and inventory that support the operation at this level. And there's about a $3.5–4 million company. Okay? So what we did is we said, look, we'll finance your permanent working capital portion of this line, which is about $550,000 on a term basis. We went out 10 years on it. And then we went down the street to the next bank and we said what they really need is about a $450,000 line of credit. You can calculate a borrowing base on receivables and inventory, that's okay. We'll subordinate to you. But what they're going to be able to do is draw down on that line when they need it and then pay it down during the course of the year or the cleanup period. They can do that with $450,000. They can't do it with $1 million. That's why we'll make the term permanent working capital loan for the $550 subordinate to the bank. We made that loan. The company's been very successful. They continue to operate, and we do deals like that all the time. Thanks.
We don't see many of the inside deals that happen between the entrepreneur and their bank or that. Recently, we're getting into another area which is very interesting, and I've already adopted 2 more players in that game. They just don't know it. This is where we have a high-tech operation that needs some very sophisticated equipment. Now, typically, you just go to the bank and that would buy the equipment and lease it back to the company. Well, the added feature is the fact that this particular group of entrepreneurs don't have any money, so after they do that, they got to pay the bank. Well, so we brought in a new player. It's called an investor. So here's how the play goes. The investor puts up the money to the bank. The entrepreneur gets the equipment and then pays the investor. Not really involved directly with the bank. So that play is still in work, and we're seeing if it works, then we're going to adopt it for some other areas. Now, what does the investor get? Well, the investor gets some ownership, plus interest, plus he's playing in the game with his money, and it's being put to good use, and you say, how do you know the use of money is correct? Guess what? He's got the contract.
So American West Bank, we take a hands-on approach with every client, including understanding their short-term and long-term needs, and then only at that point do we tailor lending and depository and treasury management products for them. So each situation is different. We had an example, it was about a year and a half ago, where we had a manufacturer come to us and they wanted to refinance their building, and they had decided they were going to go out and engage an appraiser, and of course we would engage that appraiser on their behalf. But the property came short almost $1 million, so we weren't able to move forward to do anything for them. And we said, really to do this properly, the market has to come up in price in your area where you're located. And we got to really take the time to study this. We really need to be a resource for you and engage the local market brokers who are in the owner-user property category in that north part of San Diego where your property is. So over a period of time, we engaged that prospective client with one of the brokers who's been in the business for a long time, really knew the market. And as we got closer to that 12-month period, that property had, based on current comps, come to a value where we felt very confident that collectively it was going to come in this time. And in fact, it did. It came a little higher, which was great. We were able to do the loan. We were able to provide him working capital line of credit. We asked for reviewed financial statements because their work in progress just wasn't reconciled. They were a contractor, and when you don't reconcile your work in progress, that doesn't provide a lot of confidence on the financial reporting information provided to the bank. And they were able to get that reconciled and quarterly provide a higher level to us with reviewed. We provided that working capital line of credit, and now they're looking for equipment financing, which we're happy to provide because we've got a good baseline to go with. So I think it's really a process of being a resource. It's not about being a bank that just sells products. It's more about finding solutions, and that's really why we have experienced relationship managers that we can be in a consultative position to assist those borrowers.
In the chemical industry, headquarters back in Chicago, and have a small R&D facility out here looking to expand to more California-friendly type of products, so ramp up their R&D and some pilot manufacturing. Maybe a $2.43 million in revenue operation right now, but looking to raise maybe 1.2, 1.5. What type of things do you look at in situations like that, and how might I guide them towards potential sources of capital?
We're looking for innovation a lot. So is that why he's expanding? These are rhetorical questions. A lot of questions before that. But we do have people that do those sorts of things, okay? But they're very, very specialized. And Chicago is not a problem. So if the money's going to Chicago but coming back to California, investors like to be close to their money so they can drive to it, pretty much, okay?
From a lender's perspective as opposed to an investor's perspective, usually what a lender's looking at is, does the operation throw off enough cash flow to help pay for that item over that term period, whether it's a 10-year term or whatever it is? Typically the business would finance it themselves, but they aren't able to come up with that big of a chunk at once, so they can finance little pieces of it or pay for a little bit of it as time goes on. When you're talking about a research and development type project, the concern for a traditional lender like myself would be, well, we don't know if that R&D, it could pay off and it can go up here like the hockey stick, but it might not pay off at all and it might not ever work, and we just don't know, then how is that debt going to be paid off? So that would be a concern that a lender would have.
How would you recommend, say, an engineer who wants to start a company, which really wouldn't fit probably anyone except possibly John's, and maybe it's in a lower growth manufacturing design type field, which probably isn't going to be very attractive to a lot of investors. Based on that for the future, what ways do you think we could develop as a country to be able to enable more startups of these companies that we all believe are going to be a huge benefit to the United States in the long run? Realizing it may not fit exactly with what your model is. How would you recommend we do that as a country?
I'll tell you what I see out there, and then I'll try to go from there. I see a lot of startup type manufacturers, and they're trying to get something done as cheap as possible. And they often think, do I have to go overseas to do that? What I wish was happening was where they could think, all right, how can I get this done here with the resources that are here? And usually that means one kind of a niche or another. I really wish that there was some way that we could, it really would become a subsidy, but a way to kind of offset those additional costs that we would have to keep it here as opposed to going someplace with uber cheap labor. At the end of the day, I think that it would really be a combination, like I said earlier, of investor dollars, which are typically more patient. They're willing to come in, they want a greater return, they might want a piece of the business or a piece of the operation, so the upswing is definitely higher as a way to figure out what is happening and how to get it to market. And then the debt financing, like myself and Brian would be able to provide, would be more, okay, now that we figured that out, we can go out and finance those typical small assets that help keep the business chugging along. And again, the repayment on that would be the general cash flow with the higher return coming to the investor or the angel.
Now here's what's going on. In 5 universities in this area, starting with UCSB, CSUCI, I'm on a panel tomorrow with their entrepreneur program. Pepperdine has one, Caltech, USC, UCLA. UCLA is big entrepreneurs in biotech. This one's all over the place. And all these universities have started entrepreneur programs which actually are offering a degree in entrepreneurship, which is really interesting. So you talk about where's the future going. If we are creating this eco-structure for entrepreneurs inside the universities where, and I'm an engineer, by the way, so where engineers could really extend themselves. We just finished a big program at USC, and there were 25 student groups that came forth with entrepreneur ideas, and 5 of them are fundable right now, okay? So what we're doing now is we're bringing investors right there with the students, and that's how it's going to happen. And the energy that we're seeing in these colleges and these students is unbelievable, and the creativity will blow your socks off. And they are good things, and it's not 90% software, but you better believe digital is involved in every one of them in some manner.
Fundraising ability is only getting easier. With new legislation through the Jobs Act last year, you're seeing a lot of companies with crowdsourcing and crowdfunding models, and that applies to a lot of different industries. That's only going to get easier toward the end of this year, where you can, as an entrepreneur, solicit opportunities, solicit securities openly to the general public, which is going to make it a lot easier for early stage companies to raise money. So that's a huge thing for this country. In the next 6 to 12 months, you'll see a change.
What I see is I think that's what's stopping the majority of companies from being able to start up. Because if you look, most of them are friends and family, right? Or your own personal assets. And yet we don't really have any tax advantage ways for that money to be implemented. Instead, it all goes to these much later stage companies. So in my mind, I think we need to do something to be able to make friends and family more accessible. The Jobs Act that you talk about, you need to approach accredited investors.
At this stage.
At this stage.
That's right.
Now the problem is your friends and family typically aren't accredited investors.
The one side you just said, yes, that exists, and you don't need crowdfunding to do accredited investors. I don't know why they're bothering with it. The other side is open right now, and that's, the limit on that's $1 million. And you don't have to be anybody except the person that wants to do it. Like you said, you can advertise this online, and typically the numbers are like $30,000, $40,000, $50,000, but I do know one that got $500,000. And what they can go online, and it's usually a reward-based operation. In other words, you're not selling equity. There's not one piece of stock or any equity involved in that part of crowdfunding. And God knows when the SEC is ever going to approve that for the layman, okay? But what happens is, in a reward base, you are offering the person that is donating money to you, because that's really what it is. They're donating money to you with expectation that you will excel and you will be successful. And sometimes you can say, when I produce the product, you get one of them. Or in other cases, there can be something else that you think of. And the L-Man Institute down here did a series of these particular type of crowdfunding efforts. And if you want more detail, see me and I can connect you. And some of them were very successful and some of them were terrible failures. You just never know. But the trick is, if you don't have LinkedIn groups of people that you deal with, you're going to have trouble. Because the first requirement to enter that arena is you better have a lot of friends. And by the way, it's family, friends, and fools. There's in that world, a lot of them are the latter. Okay?
Big hand for the panelists, everybody. Thank you very much.